Retirement planning has many challenges. The first is to organise your finances, to plan your finances in such a way as to be able to provide you with an income. Because when you stop work, when you retire, naturally, your salary stops and you need to be able to arrange an income from other sources. This means that you are effectively switching from accumulation mode, which you've done for the last 60 years or more, to drawdown mode in financial terms, if you like. So you need to start thinking about changing your investments from accumulating, building and growing your wealth to drawing money down. So that means if you've got significant amounts of money in the bank interests are very low, bank interest rates are very low, that's not going to be enough. You're going to need probably $3 million in the bank if you want to keep all your money in the bank and have enough money to live on. So if you haven't got $3 million, then you need to think about other alternatives. You need to move the money from the bank into something that will earn you a better return. The same sort of thing happens even with property. Now, particularly with the big increase in property prices recently, we've been finding recently that quite often we're recommending people sell their residential investment properties because the income yields are too low. The typical income yields, are 2, 3, perhaps 4% if you're lucky after all your costs. And if you're getting 3% income yield on your capital, that is really not much better than the bank, and it's not going to be enough in retirement. So you're going to have to sell that asset and think about reinvesting it in an area that will produce a higher income return for you. Shares, some people have shares, of course, before they retire, and most people try to use dividend reinvestment plans so that they accumulate and get more shares together. Again, we need to change that around, perhaps not sell the shares, but at least ensure that the dividends are paid out and are going to be giving us cash flow from now on. The most common investment vehicle for retirement is what we use with our superannuation. It's called account-based pensions. Now, account-based pensions enable you to choose an income anywhere from about 4% per annum on the capital upwards to, perhaps 10%, although you've got to get a good return if you want to draw down at the rate of 10%. You can nominate the income level that you wish to draw. You can also choose what type of investments you want for those superannuation monies. You can decide that you want to invest in a conservative sort of fashion, you can invest in a more prudent way, you can invest in a more balanced or growth focus, depending on your risk tolerance, your knowledge of investments. Of course, the conservative options will earn lower returns, but you may find that by consulting with a financial planner and getting to understand a bit more about how investments work, that the whole area of investing isn't as frightening as you thought it was. The fear is greater than the reality. And once you start to learn a little bit about investing, you will really be able to choose a style of investment that you feel comfortable with. Another key element with planning your retirement income, of course, is the age pension. Financial advisors are expert at analysing what level of age pension you may qualify for and looking at ways to increase your eligibility for age pension. So there are many things that a financial planner can help you with if you are approaching retirement. The whole aim is to stay ahead of the game. It's a changing world out there. We're going to see lots of changes in the economic environment, in tax rules. Your circumstances will change when you retire. A financial planner can help you plan your finances to work with all of those changes as time passes in your retirement years.